Well, I appreciate the chance to be up here with you guys. And I promise after all of the wonderful lunch, I won't put you to sleep. That's the easy thing. I'd rather be the guy after lunch than the guy before lunch. But before we get going, I want to see a raise of hands from you guys about how many of you guys have ever bought a business specifically? Bought a business? Okay. How many have built a business and sold it? So a lot more sales than buy. How many of you guys have interacted with a private equity or a VC fund in either of those sides of the transactions? About half of that? Yeah? Overall, good experience, bad experience, negative, both? Yeah, there's a little bit of mixed. We see that a lot of times, trying to figure out, well, if you understand what's going on in that world, you can understand how to always win going through that. So let me give you a little bit of my background in history, if we can get it to work. Oh, there we go. Okay. So my background, I'm accounting finance guy by trade, CPA for over a decade. Had the chance to be able to do studies in data analytics as well as accounting. And about 15 years ago, had the chance to run into a tiny private equity fund at the time in 2006, 2007 that was thinking hard money lending was the greatest place to be in 2007. I don't know if any of you guys were around back then, but that was not the right answer. But they looked at it and thought, there's some great things coming on. And they brought on an analyst who spent all his time in Asia looking at credit crises and mortgage crises. And he came over to the States and said, yeah, you guys are screwed. And they're like, no, this is America. That's not what happens. And he goes, yeah, you're pretty much screwed. So sell all your real estate because it's going to be bad. Turns out he was right. But his solution was not what you would think. He looked at it and said, what's going to be great is when all of this goes down the toilet, we can put together a private equity fund and buy it all back. And they looked at it and said, how do you do that? What is this? And he said, well, we'll show you. So they started up a company based here in Utah called Bridge Investment Group. And I was employee number 2 in that door. And they slowly, over a couple of years, built up. In about 10 years, they launched 7 different private equity funds, mostly based in real estate, across 5 different product classes and got $5 billion of assets under management. Went from 4 guys in a shop to 1,100 employees. And that was a great ride. It was fantastic. My job was not raising capital. It was not doing assets. It was keeping the glue in the back office, trying to figure out how do you scale $5 billion worth of assets over a really short period of time. So I had the chance to do audits and tax returns and member statements and reporting and compliance and a whole bunch of the things that none of you probably wake up in the morning and wonder why you're not doing that. But it's intriguing to look at it and say, what are the guts of this machine that you guys hear about, that some of you guys made great money with, some of you guys have wondered what the heck they're doing and they're trying to push through this stuff. But the concept of being a fund manager is kind of nebulous to most people I've ever talked to. They're like, I've heard of these weird white whales. I've kind of seen them on TV. I know with Blackstone and KKR and Apollo and some of these big names. But at the end of the day, I don't know what the heck this thing is. And that's what we're going to dive into a little bit today so that by the time you guys get out, not only do you know what these funds do and why it could be beneficial for your business, but also how do you win in working with a private equity fund. So give you a little bit of background. That story about Bridge Investment Group that went on to basically acquire $50 billion of assets and actually sold out to Apollo yesterday. Fantastic exit for all of those. Yeah, it's a great company. His son is the guy in the top left that looks way too serious. And Bridger looked at it, talked to his dad and said, hey, Dad, I got a question. He was a kid in high school and college at the time. And he said, how do I build a private equity fund? His dad goes, well, there's not really like a game plan for that. You go to business school, you go work at Blackstone and KKR and some of these big shops, and you spend a couple years, selling your soul for blood money, being an analyst, and maybe you saw enough of the company to get out of it afterwards and do some good in the world. But there's still no playbook for it. And Bridger, being an entrepreneur that he was, he looked at it and said, well, what if I build a playbook? Do you think people would buy that? His dad's like, I don't know, give it a shot. So we built a playbook. And he went out and started teaching asset managers, just like you guys, how to build a fund. Well, the crazy thing is he built a great product that could help a lot of people, but most people still didn't even know what the heck it does. It's a machine that they don't know how to use. So they're like, that'd be great, but I don't know how the rules work. I don't know what to do with it. I don't know. I'd love to build a fund, but I don't know what it is. So he built a company, Fund to Launch, that over the last 5 years has helped launch over 300 funds and currently produces anywhere from 80 to 100 new funds every single year. That is a massive dent in a marketplace that most people don't even know exists. So now there's literally hundreds of thousands of people that follow this methodology, thousands of members who work with it, hundreds of funds that get launched. And after a couple of years of putting all these together, he did them on a consulting basis, a fee for service. What he realized is everybody would come through and be like, this was a great program, but I just need somebody to help me out. And they said, nah, we don't. We just help you launch it. We don't help you out. And then those guys would run on and go, $200 million fund. The next guy's, I'd love some help. And be like, that's not what we do. And they go off and build $1 billion fund. And at some point, they start scratching their heads and be like, should we have said yes? Because maybe we should have said yes to that one. So a couple years later, Fund Launch Partners was born to take the best of the best that come through their incubation process and partner with them long term and help build and make them more successful so that people like you guys can do the things that you're probably the most valuable at as business operators, which is finding deals and building those deals. And if you've got a real passion for that, you got to go find yourself a good sales guy to raise a little bit of money for it. But just focusing on how many deals could you do if you had a giant war chest of investor capital that you knew you could grow the business with. So that's what we do. That's how we handle this. So right now we've got a $27 million fund. We've got portfolio assets of about $250 million that we're working with right now. We'll probably deploy another $20 million in the next 18 months, and we'll probably have about anywhere from $500 million to $1 billion of assets under management in the next 12 months. And the pool keeps growing and growing and growing. I'm going to show you how. So the first thing you got to look at is if you want to become a fund manager, you have to know the rules of engagement. And I love this quote because it really fits what the goal is on this one. Victorious warriors win first and then go to war, while defeated warriors go to war first and then seek to win. And this is so prevalent in the private equity space. If you get into this space and you don't know the rules, you don't know how to win, it will crush you because there's a lot of nuances to things. But if you know how to win, you know what you're doing, you know where you're going, there's absolutely an ability to win in this marketplace. But there's a bunch of things you got to know and have to understand. So we're going to start from like ground zero. This is the football analogy. So most of you guys out there, how many of you guys work with like an investment advisor? You got a RAA, 401k, something else like that? Even in college and high school, they're going to teach you that in order to get a good investment, you're going to do two things. You look at the risk and you look at the reward. But the question is, who teaches that? Is it the guy with the money? No, it's the guy investing your money. It's kind of a weird kicker. You never realize it. But if you see somebody say, it's all risk, reward, risk, reward, risk, reward, you're on the other side of the table. You probably don't realize it. But that's not the way to go about it. That's not how you build a private equity fund. That's probably not what you guys do as entrepreneurs as well. Because there's something really key that's missing in that strategy. And let's just put yourselves in the scenario. So you've got your spouse, and you come home and you say, honey, I love this entrepreneur gig. And they'll be like, yeah, I know. And look at it and say, I've got this idea. We're just going to do this great risk-reward play. I'm going to mortgage everything we have on the planet, and it's going to be the best risk profile ever. We're just going to make a ton of money. So I'm going to go take out all the debt I can. We're going to risk everything, and we're going to make a whole bunch of money. How many of your spouses would sign off on that gig? Is that how it even works? Well, the answer is no, that's not how it works, because investment managers like you guys, or entrepreneurs, have one element that they don't teach you in school, they don't focus on. They tell you that there's risk, and they tell you that there's a return. Those are innate, yeah. But you guys are entrepreneurs. You control scenarios. You mitigate risk. You leverage returns. And if you're the guy who adds control to that investment, then great, you know which side of the table you're on. If you're going to somebody and just saying, hey, take a bet on me, and let me invest the money and see what I can do with it, you're on the other side of the table. So I'm betting that everybody here in this room today, you're on the control side of the table, not the risk-return side of the table. Is that a fair assumption? So far, so good? Okay. So once you've got this, we'll skip through a couple of these. then there's something you've got to understand to have a private equity fund, and it's applicable to being an entrepreneur, being an asset manager, which is trying to find out your competitive edge. Because if you're going to control something, you got to know what it is you're in control of. And it might be your strategy, it might be your team, might be your asset class, might be your structure, like organizational structure. But our rule we go with, and I think we saw 1,250 private equity funds to potentially invest into in the last 18 months. That is a ton of sample size. And the one question every single time we ask is, what gives these asset managers a fundamental right to win in their space? What are they the best at? What is the proprietary advantage, the intellectual property, the timing, the mix, the pipeline? There's got to be something that makes them better than the other guy. Otherwise, it's just a risk-return reward, and nobody needs that kind of stuff. And for those of you who are like in the financial sector, they often call that an alpha. What is your ability to produce above-market returns in the same kind of scenario? We look at that and say, what are you better at than the next guy? And if you can leverage that and do something, that's your alpha. That's your unique edge or your competitive edge. So as a fund manager, first thing you got to know is, what are you better at than the next guy? The next thing is identifying the market opportunity. So I mentioned that there's a lot of shift happening in the macroeconomic. So you guys okay if I go give you a little macroeconomic study right now of what's going on in the marketplace? Promise has nothing to do with politics. Everything to do with money right now. So where are all the US assets held right now? So this is an interesting thing that you probably don't get to see from C-SPAN. But this is kind of a breakout of where we're at with our assets under management for the US. And if you look at it, US equities in that bottom left, that blue corner is a lot of what you'll see is like public stocks, public equities, everything else that's out there. That's the stuff you'll trade on the NASDAQ and New York Stock Exchange, and a lot of people have their portfolios in there. Alternative assets are a small fraction of it. Right now, they're about 25% of the US economy. If I showed you the same thing about 15 years ago, it'd be about 15% of the economy, because there were a lot more publicly traded companies, there were a lot more public equities, a lot more people had US, basically IPO'd equities. But alternatives started getting bigger and bigger and bigger. And here's the easy litmus test. How many of you guys have friends that are still stockbrokers? Anybody? How many of you really love your Microsoft stock in your 401k? Nobody? Some? A couple? It's actually doing really well. That's a trick question on it. But the whole kicker is nobody's looking to put a whole bunch of money and be like, you know what would be great? I would love a well-balanced mutual fund or a nice target-dated Vanguard mutual for a 2016 term retirement date. Nobody says that. If you got 30, 50 million, or 30 or 50K, 100K, 250,000, you're looking at it saying, I want to be engaged. A lot of people ask us on a regular basis, like, how do I raise capital for a fund or for a business or for an enterprise? And it boils down to two super simple, easy answers. You have to have a unique engagement. Unique. That's hard. And it's got to be engaging. They have to do something with it. Do you have a unique engagement with your Microsoft stock? I don't know. Not too unique. Not really. I'd probably say Tesla maybe has a little bit more of an engagement than most. But most of them don't have a unique engagement. That one's a little bit weird. And you have to have a compelling story. Most people don't have a story to tell about their capital, let alone making it compelling. Is it memorable? So if you don't have a unique engagement and a compelling story, forget it. Now, on this little pie chart here, US Treasuries, do those have unique engagements, compelling stories? No. How about bonds? Let's go a step further. What about your cute muni bond? Again, I got state tax benefits. That's kind of. US equities? Maybe a little bit more. But by and large, we are seeing a huge flood into alternative investments. It's your buddy's real estate company that you're into. It's an apartment building you're investing into. It's somebody who wants to start up a crumble franchise. I mean, that just seems to be on the rise everywhere. But it's those things that you're like, I'm not even in a control position, but I just want to be a part of something. I want to know my money's doing something. I get some kind of an engagement. Somebody can call me up and be like, you've been waiting for this call. This is that call because it finally worked out. and we're going to have a party, we're going to celebrate because thank you for trusting me as an investor, it worked. And those are the kind of things that happen in alternative assets. So the crazy part about this, for any of you guys who are dealing with any kind of money, currently 37 trillion with a T of US bonds are issued at an average rate of 3.4-ish%. That's your competition. Can you give a more compelling story or a more unique engagement than a 3.4% return on the least sexy asset class on the planet? Can you? If you can do better than that, there's opportunity for you. So we're going to talk about how that all works because that's your competition. Let's see. Okay, so we talked about alternatives just a little bit. And I got to give you the landscape because most of these private equity funds are in this alternative landscape. There's hedge funds that trade on the stock market, and those are out there. And in my opinion, every one of those will get decimated by AI in the next 5 years. So that's a whole other ball of wax. Alternative investments, what are those? Those are real estate. Those are hedge funds. Private equity is like buying out these baby boomer companies, these manufacturing, these blue collar, hard tech, engineering firms, a lot of personal service companies. Right now there's a lot of roll-ups that's happening in accounting firms or tax firms or architectural firms or engineering firms. Like personal service businesses are getting rolled up. You got things like commodities, and you actually have quite a few assets that are in infrastructure. Like you hear them every once in a while that it's like a water treatment plant got sold. You're like, what? Did those sell? A toll road got sold. A bridge got sold. You're like, is that a thing? Yeah, it's a thing. Happens a lot in some of these private equity funds. Power distribution lines is actually a very lucrative market to buy and sell power lines. Go figure. So you've got multiple sources of different things you can invest into. Again, going back to the basics, what do you know you have a fundamental right to win in? If you're a real estate guy, don't buy bridges. I'm just saying, stick to your core competency and wherever that's at, and it covers a lot of different things. So what is the difference between a fund and probably what you guys have all experienced? You've all experienced buying and selling assets. Seems like more than half the room has been in this environment before. But you look at it and say, okay, what is this? So we'll give you a few different things. When somebody buys and sells a single asset, you'll often hear it referred a couple different ways. So I'll give you some terminology. A single asset, you might use what they call a special purpose vehicle, SPV, and that's just the legal entity that you organize, or you hear it as a special purpose entity, SPE, and that's the type of legal structure. You'll get a couple of investors, they'll invest into it. They're usually like limited liability companies, LLCs. You get a whole bunch of people together, they raise a bunch of money, and you'll get what they call a sponsor, the guy who's running the deal, the guy with the control element. He comes to you and says, hey, I want you to come in, lend me your money, I'll give you a cut. That'll be like your distribution. I want a little bit of a carried interest, what they call, or some kind of a promote is sometimes they refer to it. And that's my deal, or my reward on the upside for putting your money in, doing the deal, making it all work. So we go through this cycle. A lot of times they'll call them a syndication or a one-off deal. So this syndication is you find a deal, you structure the offering, you go out to everybody, raise the capital, ask them if they'll support you, you do the deal, you give the money back to them. That's a big part of it. You don't close the loop until you actually give the money back. There's a lot of people who just want to keep the money and say, can we just do that again and again and again? Well, the crappy thing with the syndication is you have to close the deal up and start all over again. And you guys that have been through, how many of you guys, again, have been through a business sale? Yeah? Okay, business sale. How much energy do you have to go jump into a new deal by the time you get through that one sale? Yeah? You take time off? Yeah, you probably need a lot of time off. You get deal fatigue. It's exhausting. There's a lot of things involved in getting rid of businesses. Even for a big fat pile of money, it can be exhausting. So as easy it is to look at it and go, hey, we just gave you a healthy distribution, a big chunk of money, massive return, sometimes getting back into that game gets really, really hard. Or it was the deal of the lifetime, so it was really hard to figure out. Well, this is where a one-off deal differs from a fund structure. And this is mechanics. In a fund structure, you got to think of it as the fund represents a machine, where really what you're doing is raising capital and doing a bunch of deals. Oftentimes they call it a pooled investment fund. and then you distribute the returns. But what you're trying to build is a factory that pumps out opportunities. It's not just doing one deal, it's figuring out most viable first-time funds are 5 deals. And that's a totally different kind of a business if you guys are entrepreneurs. Anybody can run one business and just work their guts out. But there's no way that you can work your guts out on 5 businesses at a time without burning out. You have to scale. You got to go figure out, what are my limited resources? What are the biggest bang for my buck? How do I optimize it? Because if you're trying to run all 5 at the same time, you're toast. You're going to burn out. You end up divorced, broke, or maybe you end up really rich and unhappy. That's not a very good ending. So the concept is, when you build a fund, have a pipeline. And the cool thing is, if you always have deals coming in, you can always raise capital for those deals. And if you always have deals coming in, you're building something, you're opportunistically value-adding it, you're changing it around, and inevitably, you're probably going to have businesses you're buying at about the same time the businesses are maturing and you're selling. So the kicker on this one that I want you guys to take away from it is, building a fund means you're committing to a factory. And that factory takes in capital, value adds the deals, and pumps out investor returns. And that machine in the middle is what you guys control. So you got to be scalable. You got to be opportunistic. One of the things that's unique with the funds is they're actually time dated. I mean, there's private equity funds that do like hedge fund trading. But the big kicker is the fact that most private equity funds are 5 to 7 years. Now, how many of you guys have got into a business and said, I'm just going to run this till the end of time, and it'll be the best business, it'll be the biggest thing in the world, and then I'm out? Yeah? It seems like a great idea. But how many of you went into it and said, you know what? I think this is going to take 3 years. I bet I could get in. I know exactly what I'm going to do. I know where I'm going to leverage. I know what this business needs. And if I'm not done in 3 years, you can my butt because I was the wrong guy, or we've already sold it off and we've made money. Now, which one would you want to listen to? The first guy that's like, I'll buy it and I'll hold it forever, or the guy who's like, I'm getting in, I'm getting it done, and then I'm getting out? Where do you want your money to go? The second one. And if the guy says, you know, not only am I going to do that once, I'm going to build a factory that pumps out those kind of opportunities. As an investor, now what are you thinking? Like, that guy's going to have my money for a long time because this is going to be really, really, really good. That's the fundamental structure of a fund that is very different than a one-off. The crazy thing is, it's people like you guys who make some of the best fund managers, because you understand how to buy a business, how to turn around a business, how to grow a business, how to retrofit a business, how to combine businesses, and how to sell businesses. And there's vendors all over this room that can help you with those transactions to be able to figure it out. The fund just represents a different mind frame. It's not do it once, it's do it again and again and again and again. And make sure you have the end in sight of where you're going. We go back to that same thing. You got to figure out how to win first, and then go onto the battlefield. And this is the roadmap. So let me show you the fund launch formula. And this is what we've used to literally start and get off hundreds of funds off the ground and be able to help make successful managers all over the planet. So step 1 is you got to find a deal or a strategy. And we're on the left side here on the fund launch. You've got to frame it and structure it, and then see if you can finance it. So let me give you an example of how it works. I'm looking at it saying, I want to build a real estate empire. So I'm going to go find a whole bunch of duplexes in an area that's got plenty of need. And I'm going to go and say, I'm going to raise $10 million, and I'll take out another $20 million of debt, and I'm just going to go find duplexes, buy them, rehab them, rent them out, and then sell them. And there's a great little cash flow pool associated to it. I have to go to investors now and look at it and go, here's the structure. I'm going to do all these things. I'm going to give you 80% of the upside, and I'll keep 20, after you get your capital back. So I'm going to make sure you get all your money back, and you make it 20%, and then give you 80% of the returns, and I'll keep 20. Pretty decent deal. Well, I need to turn my lights on and keep the office working, so I'll take a management fee of 2% while we're doing it. It's a tiny little portion of it. So I'll create a 2 and 20 fund, is what they call them. So a 2% management fee and a 20% profit interest on the back end, and I'll create this fund. And I'm going to go out to the market and have to try to raise capital and see who trusts me to do that kind of a model. Do I have the clout? Do I have the background and credibility? Do I have the team? Am I in the right market? There's a whole bunch of different factors, but all of those should be items that you can deliberately control. Probably the hardest one is your experience. If somebody comes to the table and says, hey, I've been doing all sorts of pizza franchises my entire life, and you know what I should really do now? Commercial real estate. I think I'm perfect guy for commercial real estate. Like, how about franchises? Why don't you just stick to franchises? But, so that's the aspect. And you might do a whole bunch of one-off deals, like single asset funds or SPVs or SPEs, what they're usually referred to, and just keep running through that cycle. Maybe you need more deal experience. Maybe you need a better pitch. Maybe you need different investors. But as long as you keep on working that and churning that through, that cycle is going to get you to the point where you can really look at it, and that's the next step, is just get validation. When investors finally look at it and go, you know what? You've been pitching this thing for 2 years now, and I've watched, and you did one deal, and I didn't get into that. And you did another deal, and I didn't get into that. And then you launched a fund, and you did 2 more deals, and I didn't get into that. And I think it's about a time I get into that, because it seems like you know what the heck you're talking about. That happens all the time. The amount of people that just kick the tires and watch in the investment world, there's a lot. So institutions like family offices, insurance companies, big endowment funds and pensions, most of them have a rule that they won't even get into people's first fund, period. That's just like a blanket rule, because they're like, we just want to see if you can pull it off. And it's nothing personal. You could be the best asset manager out of Blackstone possible, but they just say, yeah, rule says you got to prove it at least once. So we tell everybody, go raise a $10 million fund, go do 5 assets, get that thing 2 or 3 years down the road, and you'll find that fund 2, you're going to catch a lot more of that low-hanging fruit from the big guys. The funny thing is, most of those institutional big $10, $20, $50 million checks, everybody's like, if I just had one investor with $10 million, I'd be set. You're not going to find it. It's not going to happen. You might, if you're lucky. But more realistically is you're going to find a couple of $50 million checks on your 3rd fund. And that's when things get really, really humming. But you got to build it. So you get it validated. You go form all the legal documents. Fund Launch does this all the time. More than happy to connect you with the guys on there. And put together your entity. And it costs somewhere between $30,000 to $50,000 to be able to get a fund launched. And that's a pretty decent investment. Cool thing is, most funds you set up, the investors are willing to take the financial responsibility for that. So you go raise $2 million, you can use $50,000 to reimburse you for setting up a fund. That's really nice. It's like cover your cost if you can build it. And then from there, launch your fund. Go out, start taking subscriptions, do your registration, do your compliance stuff, bring in the money and start doing your deals. And suddenly, you're a fund manager. Congratulations. This is where the fun part kicks in, because now you've got to build the factory with the assets you've got. So you go raise money, and the cool thing is you can raise money at the same time you're buying assets. At the same time you can build the value in those assets and sell the assets and continue to raise money. So in a fund, very common, 5 to 7 year fund. You go raise money for 2 years. You deploy that money for the first 3 years, 4 years. And there probably is a time where you're fixing, you're rehabbing, you're repositioning, you're turning around those companies somewhere in the middle. And then in a usual fund structure, you hit the point where they call the harvest period. And the harvest period is you've done all the fun, you've raised the money, you've bought a whole bunch of assets, you've turned them around, and now it's just time to close things down. So after that harvest period ends, then you just start liquidating assets and giving the money back to the investors. Now, I don't know about you guys, but if I gave somebody my money, and they've been running multiple deals for 5 or 6 years, and they finally said, hey, we're winding up all this stuff. We've just got to give you this big pile of money and return it to your pockets. As an investor, how many of you guys would ask them to do it again? Yeah, a few of you guys out there? That's usually how it works. So you give all the money back to the investors, and they said, you know what we're going to do? Pay a couple of taxes, take a little bit of vacation, and then how about you do it all over again? Because that was a unique engagement and a really compelling story. And I told all my friends about how much fun this was to be an investor in your fund, in that deal, in being able to do that exercise. And the amount of people that come on successful follow-along funds to the 2nd, 3rd, 4th, and 5th and bring their friends and family, it's actually shocking how many people that find a unique engagement and just look at it and go, that was the funnest investor experience I never had to do anything with. Like, let's do that all over again, because I felt like I was along for the ride, and that was really exciting. Let's do it again. So that fund management just keeps going again, and you can stagger all these funds and be able to launch them. So a lot of people in a whole bunch of presentations we talked through said, what does that actually look like? So for you guys that are accountants or lawyers or CPAs, just take a picture. This is the standard structure that you're going to get from a private equity investment fund. So if you ever have to go to your lawyer or go to your accountant and say, hey, this guy up on stage talking really fast told me this is what I need to put together for a fund, you actually have that on hand. We won't get into the details on that. A lot of people say, what is the fund structure in terms of a waterfall? How do you get paid as a manager? Again, I'm just going to put it up there. Take too long to explain through, but this is a standard example of what you might look like in things. So we'll kick through, so we got a couple more. We got a little bit of time for Q&A. The biggest crux I think you guys will fall into as operators of businesses and as fund managers is this critical question. What are your limited resources? Now, let me give you an example on this. As a restaurateur, you've got to worry about waiters, waitresses, customers, food. At any point, running a restaurant is the biggest question on your mind. How do I get another $1 million into the business? It's probably not. That's not your limited constraint in a restaurant to be able to make that grow. You might have limitations like capacity limitations. You might have marketing limitations. But one of the biggest things in this kind of a scenario is you have to know that capital coming in is your limited constraint. So that's a step first. What's your limited constraint? The second one is find the 3 roles in every fund. And a kicker that's very different than traditional entrepreneurship is there is 3 distinct roles, and I can tell you from blatant experience, these are probably not the same guy or gal. They're very different personalities, they're very different backgrounds, they're very different skill sets, and if you don't balance them, it's very hard to operate because you need conservative and aggressive personalities in these kind of partnerships. The cool thing is, most industries are just get like 3 people together and see if it works. With a fund, they're actually very, very, very distinct personalities you can find. So first one is the expert investor. You got to know somebody who knows a lot about that asset class. They have to know apartments. They have to know land acquisition. They have to know oil and gas. Whatever that asset class is, you want to find the best of the best technician. And how I always equate it is if you're going to go into like special ops for the military, if you've got your SEAL team, how many captains do you need? 1. How many snipers would you need on a special ops team? 1, maybe 2. How many like weapons experts? 1. If you have an entire SEAL team full of captains, how effective is that team going to be? It's not. The hardest part is knowing whether you're the guy who takes that skilled shot or you're the captain managing who's taking that skilled shot. A private equity fund is very distinct in making sure you know exactly who's going to do what skills. That expert investor is very keenly the guy who's got to 100% be responsible for the asset quality, for turning around those assets. The next one, far right, capital raiser. If everybody's like, we can do the coolest asset turnarounds ever, but nobody wants to raise the money, guess how far that fund's going to get? Yeah, you're not getting anywhere. You got to make sure you've got somebody who loves raising capital, a sales guy born in and out. Fund manager, that's the third one. The fund manager is interesting. There's a lot of traditional firms that can do third-party administration. They can do audit and tax. They can do underwriting. They can do valuation. They can do a lot of different parts of it. The fund manager, the world I came from, in a lot of aspects, you can part a lot of that stuff out. We've seen some really, really successful private equity funds come from a guy who knows their asset class and a guy who can raise money from it. And then you bolt in somebody who can glue it all together, make a firm out of it, you can probably be successful. So if any of you were thinking today that you had to end up being the CPA doing the taxes to make a successful fund, coming from the CPA who does taxes for successful funds, you don't have to be that guy. Because you can be an expert investor and capital raiser and make it work. Okay, we're getting quite to the end and wrap it up. But I think a lot of people ask the different parts of the fund to understand that. So I'm just going to put this up and then we'll kick over to some Q&A real quick. But there's a lot of parts to the fund. There's a lot of roles and responsibilities that you guys can take. But I think at the end of the day, the number one thing, if you can take anything away from this, is just what is that unique, compelling edge that you have that you can control? What area of the business world do you have a fundamental right to win in? And do you have the ability to scale that across multiple assets? If you do, fund could probably work for you. If you're not ready yet, if it's not there yet, maybe hang out a little bit. Keep doing deals and be able to figure it out. So, okay. So we've got the risk control return. We'll just skip to the rest of them on that. There you go. So develop your alpha, your control, identify the market, which is also part in the wheelhouse, and then structure your offering to scale. And those are probably the most key items that you've got. So I appreciate you guys listening to it. Hopefully you learned a lot more about funds and what to be able to do and some of those differences. And I'll be around for a while, so appreciate you guys being here, and I hope you guys are successful in your businesses. So thank you.